YNABers, my name is Jesse Meekum from YNAB. It stands for You Need a Budget. Yes, you do. This is another Whiteboard Wednesday where we're talking about investing. We're following along in the book I wrote, Invest Like a Pro. It's available on Amazon. Dirt cheap, as cheap as I could possibly price it and stay within their rules. So we've talked a lot about all sorts of fundamentals of investing, and today we're going to hit into the specific asset classes, not all of them, but the basics of what you can invest in. You can invest in this day and age, virtually anything, but we're going to talk about the three basics: stocks, bonds, cash. We all know what cash is, so we don't really need to talk about that one, although there are risks in holding too much cash, opportunity cost, inflation, things like that. We'll talk about stocks today, okay? So when you're talking about stocks, you can get really fancy sounding and all of that, but we're going to keep it to the basics. What is a stock? A stock is simply ownership in a company. Porter, for his birthday last year, I gave him 1 share of Apple stock. I was very prescient. I wanted to teach him a lesson about how value fluctuates, and he would learn a lesson if the value went down, because the share was worth $100, which frankly is a lot to spend on a kid's birthday present, in my budget's opinion. So we bought that stock for him. It's now worth $155. Lesson not learned. Porter thinks all stocks go up all the time, so we've had to kind of go over that a little bit. A stock is ownership in a company, no more, no less. That is it. When you buy a stock of something, you are an owner in that company, public company, naturally. How are things valued? Well, honestly, and this is a bit of a cop-out answer, but the stock is valued by asking yourself what it will fetch if in the market. If there's someone else that will pay you $20 for your share of that company, then it's worth $20. If someone else would pay you $25, it's worth $25. But you look at what they're actually selling for, and you'd say, okay, that stock is now worth that. When you multiply all of the shares outstanding for a company like Apple or any company, and then you multiply it by its current stock price, you get what's called the market capitalization, or market cap if you're in a hurry, and that just means what the company is worth today. So a lot of times you'll hear those words thrown around, and that's what that means. When I gave Porter that share of Apple, he said, "Dad, what percentage of Apple do I own now?" And I said, "Man, they have millions of shares outstanding." And he was pretty bummed about that, because he saw that maybe it wasn't so fancy after all. So if stock is just ownership in a company, and we've talked about how diversifying is so important, where you don't want to have all your eggs in one basket. That's been a fundamental that we've hit a lot of times now. When you're buying a stock in a company, you have to recognize that you're putting all of your eggs in that one basket. So how do you invest in stocks? You diversify, and you do that automatically through lots of different vehicles, but we'll talk about 3 in particular. The first one you hear a lot about when you want to buy stocks is mutual funds. Mutual funds are usually managed by a team whose job it is to make that fund grow as big as it possibly can. They can do that by attracting more investors, and also by having the assets that that fund holds increase in value. They're paid usually a management fee, and it's a percentage of the assets. So they're very incentivized to have that asset base grow, either through investors coming in, so they got to look really good to the investors, or again to the underlying assets increasing in value. I'm not a huge fan of mutual funds because there are cheaper options to invest in virtually the same way. When we talked about the things you can control when investing, and we talked about how important it was when things can crank down on that rate of return, one of those things that really crank down in a negative way on the rate of return are your investment costs. It's essentially these management fees. And you'll have mutual funds that will be very expensive. They're being pushed down in price as they become more competitive. But did you know this? There are actually, and this is crazy, there are actually more mutual funds than there are stocks available to purchase. So when someone says, hey, just find the best mutual fund and invest in that, find a couple great mutual funds and invest in those. Well, good luck. That's harder than finding a great stock and investing in that. Granted, it's going to be more diversified, but there are so many mutual funds now. It's very hard to find the ones that actually shine. And some that shine now don't shine later. It's just extremely difficult to pick a mutual fund that will outperform the market. So what we do is we try to not outperform the market, but just perform at the market average. If you perform at the market average, you actually beat 70% of the market. That works. Research shows it, even though the math at first blush sounds kind of confusing. So how do we invest in stocks? We invest in what's called index funds. These index funds are not actively managed, they're passively managed, and they simply track an index. Like, I want to invest in the Dow Jones, and I want to keep my investment proportionate to the market capitalization of those Dow Jones companies, or of all of the 500 companies in the S&P 500, or all of the 2,000, is it 2,000 in the Russell 2000 index, or all of the companies in the NASDAQ. So you can pick and choose. One thing that's great, you can actually pick an index fund that invests proportionally to the market capitalization of every single company that is listed on the U.S. stock exchange. So I don't remember what the ticker is now, but it's from Vanguard. Not promoting it, oh my gosh, not promoting it, just for educational purposes. You can invest with one click. You can buy a share that proportionally owns every single share of the stock market. And then what you're investing in is the economy overall. And again, over the long term. These things go like this over time. They can go like this over time for quite a while. They can go like that for a while. You just don't know. So what do? You just keep on plugging away. You look at things you can control, to go back to last week. So you want to go passive. That means index funds. Even better, there are even cheaper options now called ETFs. They're not that new anymore. ETFs are even cheaper. We're talking fractions of a percent as the cost of owning an ETF. You have to be careful of trading fees and things like that, but the best thing you do with an ETF is just never sell it. You buy it, you just buy it, you buy it, and you buy it in big enough chunks where those per transaction trading fees are actually negligible. Finally, just to recap, again, we're going over stocks, and this is like a flyby type of view. You can go so deep with these and spend your entire career as a PhD in investigating these and running numbers on these. And there are people so smart and so well equipped to make so much money investing in stocks that it is absolutely crazy. Most people, on average, don't want to have this be their full-time job. That's certainly my case, and I'm guessing it's probably your case. So what do? We just accept the market average. Over the long term, the market is going to climb. We're banking on economic growth. We're doing that through the cheapest option we can possibly control, which is an index fund or an ETF, investing in a broad basket of stocks, like the entire U.S. or the entire international stock market. And those are easy enough to find. If you guys have any questions, you can post them, and I'm sure other YNABers that are very, very well versed in investing can give you the answers. One book that I would recommend, if you really want to kind of dig into this, is by John Bogle. It's called The Little Book of Common Sense Investing, if you want to kind of dig into that aspect of it specifically. Otherwise, just hang on tight, accept that that was a high-level summary, and next week we'll cover bonds and what those mean. And I'm frankly kind of looking forward to it. This has been a fun run. I'll see you next week.